Hi, it's Darren, and welcome to the Encore at Wynn in Las Vegas. We've just finished off day 2 of the Forbes Shook Top Advisors Summit. I'm the only Canadian who's here, the only Canadian advisor who made the trip. Others were invited, but I'm the one who attended. There's 1,000 advisors here, and they mentioned that in aggregate we manage a little over $1 trillion. So these are the top advisors across the United States. Really interesting group to meet and network with. We've also had an incredible array of speakers in the last day and a half. I'm going to hit the highlights for you of just 10 of, I think, the most interesting ones. It's a very interesting format. They give each speaker 15 minutes to kind of hit the highlights of their content, and then we can always follow up with them later. So I'm going to run you through the garden really quickly of what I thought were some of the more interesting conversations and information we've heard today. So we started off with a little pre-conference lunch with Richard Bernstein, who used to be the Chief Investment Officer for Merrill Lynch. He runs his own firm now. I got to hear Rich several years ago when I visited him at his office in Manhattan, and I really like his outlook. And I found out he has a managed ETF portfolio that isn't yet available in Canada. So I'm going to be working with our back office and see if we can get access to it, because I think it's a very impressive idea, and it'd be great to get his knowledge and expertise in an ETF format that would allow us to get his global risk mandate. We also heard from Capital Group, one of our favorite long-term managers. One of their analysts had done some work on kind of the major lessons learned over the last 10 years about what themes and what strategies and what concepts are persistent in terms of delivering outperformance. So a lot of good material there we'll be following up with. And we heard from Chris Davis, who I got to hear at the Barron's Conference in Nashville earlier this year. Big fan of Chris, and he had a whole bunch of charts and slides. I'm going to see if I can get copies of them from him, which gives us some really good exhibits about how to manage through corrections and markets. And one of the concepts he mentioned, I really like this, is he said, fragility is the enemy of compounding. And I'll dig into that a little deeper. I think that actually might be a Commonwealth Academy video that we do. But I like this concept of fragility and how we manage against it. And we've always tried to build portfolios that are anti-fragile, which is a whole other concept we'll get to. The MIT Age Lab. So as you know, Dr. Joe Coughlin, great friend of ours, done some events for us. We've done videos with Dr. Joe. 3 separate presenters mentioned the work of the Age Lab. So on the last one, I sent Dr. Joe a note and I said, your ears must be burning. And that led to a conversation where I'm going to go down and have a visit with Dr. Joe at the Age Lab in December. So that was fun. The CIO of BlackRock, the Chief Investment Officer for BlackRock, one of the largest asset managers in the world. He went through a market overview, lots of charts and graphs. What I was really interested in is I've been working on with the team a bit of a pivot we're going to make in some of our portfolios. I think when we get through the next 2 interest rate increases, which everybody here is certain we're going to get in the United States. And my thesis was he had 5 slides confirming my idea. Fantastic. Maybe I'm from the future. But that was great to hear that. He also talked about the amount of volatility and speculation that's embedded in the market today. And one of the numbers that he mentioned, you'll find this interesting. He said there is daily over $1 trillion of index put options that are traded. That's just one type of option that's traded. And to give you a comparison, all of Las Vegas, I don't know why they put these investment conferences in Las Vegas, all of Las Vegas gambling is about $200 million a day. So that's an interesting statistic. So he says speculation is basically at record highs, which is one of the reasons you're seeing the volatility become so incredibly extreme. But again, I have an idea, he confirmed my idea, and then actually another presenter confirmed it. So we got a few action steps. So that was really, really helpful. We had a presentation from KKR, which is the 3rd largest infrastructure manager in the world. That was really helpful. And as you know, in our pooled fund and in almost all of our portfolios, there's a sleeve I put in for real property and infrastructure. So great to hear some themes and insights from one of the largest infrastructure managers in the world. So we're very aligned to what they're up to. We had a really special exit interview with a guy by the name of Bill Miller. I'm going to encourage you to Google him, and I'm going to put a chart up here somewhere, or maybe right in front of me, which shows you his performance when he ran the Legg Mason Value Fund. He has probably one of the longest and greatest track records of any investor in history. For 15 years straight, he beat the S&P 500, a remarkable achievement. So he was talking about the lessons he learned over his career now that he's retired. And one of the statements he made, it really struck me, and I want you to think about this too. He said, look, I don't know time, but I do know price. And I think that's something for us to be very mindful of. It's always been something I thought about a lot as we invest. And that's been helpful to not lure us into things that we probably shouldn't buy because they're too expensive. It certainly helped us in 2020 not to get caught up in that. Speaking of which, then we had a fireside chat with Kathy Wood, who's the founder of ARC Funds. Now, Kathy, a couple years ago, was probably the most popular investor because they invest in disruptive technologies. You know, all the internet stuff, genomics, really, really cool, kind of where the future is going to go investments. And her performance was remarkable. In 2019, her flagship fund was up 35%. In 2020, in the pandemic, she was up 152%. And as we know, investors chase returns. So very few people got that track record. They all jumped in very close to the end because her numbers were amazing. She's getting lots of press. In 2021, her fund was down 23%. And so far this year, she's down 60. I looked her numbers up today. So that's an interesting, and I'll show you the graph of her performance so you can see what the roller coaster ride is. So I'll put that up here somewhere. So she's basically back to where the market did, but wow, what an experience. Tragically though, for investors, they didn't get in at the beginning and ride it up. Most got in right at the top or very close to the top and have experienced tremendous losses. I wouldn't be surprised if her average investor is down 50 to 80% or more. So it was interesting to hear from her, given the climate she's been in. She's still very convinced on this disruptive technology thing. I agree with her, by the way. Some of the trends that she's focused on are not going away. I actually think her portfolio is more interesting now than it's ever been because so much of that overpricing or overvaluation has gone away. So we'll be giving her funds a closer look. She also had an interesting comment. There's been a lot of talk about the Fed and inflation and interest rates. That's been part of every single presentation pretty much. But she had an interesting comment. She said, no one is making big bets here. There's record cash. And what she was referring to is that investors, professionals and retail investors are kind of sitting on their hands. Everybody's a little scared. So it does pay to be bold. We also got to hear from, and this was a really, you guys know, I've done all my, so many of my market updates using data from JP Morgan. They produce, I think, the best chart book that we have access to in the industry. They do a quarterly, actually it comes out monthly, and there's even a daily version if you want to read that much, a data book, which is all called the Guide to the Market. So Dr. David Kelly, who's the guy who prints the thing, does all the research, he presented and he went through, and I love his stuff because it's all data driven, right? All of his themes and everything, it's just data. And so he took us through some of the more critical data points. And he was saying that the data shows there's lots of talk about is there a recession coming or not. He was saying that no, the data says that's not likely because some of what he called the four horsemen or four of the key data points, and I'll do another video where we talk about that, he said they're all showing good. So even if there is a recession because the Fed forces us into one, he says it's going to be a mild one. He said it's like falling out of the basement window. You're not really going to get hurt. So not really a need to worry about that. And then I was so pleased. He also confirmed the same investment thesis that I'm going to be working on as we go through into the fall and towards Christmas time. Because there's probably, as I say, 2 more interest rate increases coming. That seems to be the betting line. And when that's done, I think we'll make some of our adjustments to that. He also talked about consumer sentiment now is probably the lowest it's been since the 1970s. And that's actually historically proven to be one of the best indicators is you want to buy when there's maximum fear because that generates the best long-term returns. And he says we are very much in that space right now. Again, timing nobody knows, but we do know price. And the prices are very, very good. We then got to wrap up today. There's still more things going on, but I'm going to just hit my number 10 for today, which was a great presentation by Dr. Jeremy Siegel, who I first met over 25 years ago. And he wrote a book called Stocks for the Long Run, where he looked at the long-term return pattern of the markets. And that is, I think, very, very helpful now. And he said that when he measures going back to 1802, the long-run real rate of return, or the return after inflation of investing in wonderful companies, is 6.7%. And he says he's measured that, and he measured it just again very recently after the decline we've seen in 2022. And he said we are still on that long-term average. And what that means is that if you can stay in your seat and not get panicked out by the noise, the market will reward you with returns dramatically ahead of inflation. And I think that's probably the best place for us to close today, that we'll stay invested, stay on our discipline. We've had a chance to listen to some of the greatest investment minds that exist today with history that we can't really refute, and there's more coming up tomorrow. So with that, I'm going to go back. I will stay away from the blackjack tables, but I will have a nice dinner, and I'll talk to you again tomorrow. Thanks for watching.